Investment offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to any results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hey everybody, welcome to Vantage Point with True North Wealth Partners. Today is Thursday, June 22nd, episode number 35. So we're almost to our 3-year anniversary, which is next month, but time goes by fast when you're having fun, so it's incredible. So Eric Sousa here, and we have the other E.
Eric Biddle.
All right, so it's the E&E show today. So we actually have Russ in the office today. I said, you want to do a cameo, but he's working with some estate planning for some clients of ours, getting their gear in track there. But on behalf of everybody here, Stacy, Russ, Andy's having fun today, working hard, and then Jim Piccolo as well. So we all say hi, everyone, and happy summertime. So with that, let's get into it. This will be a little different. No, we're not going to have the big chart pack at the end. We're just going to sort of go through topics today, and I'll hold up a few things and just talk about sort of what's going on and how the effect of higher interest rates are helping pretty much everybody except for those who have debt.
Yeah, that's true.
Yeah. Well, with that being said, let's just get into the overall markets, I guess, and what the Fed, last month, et cetera. So the Fed, obviously, they paused, and Andy and I and you were talking earlier. Just it's they talked about, okay, well, we're going to raise rates 1-2 more times. It's like, why'd you pause? So I'd rather just take the medicine, get it over with. So I hear it. So the upshot is, they're trying to let the data to come in and data dependency and all that stuff. But so in July, it's a live meeting. Obviously, there is an anticipation the market's over 80% chance that there's going to be a rate increase of 25 basis points. So again, we'll see. But we're not really too concerned of how many more rates, 1 or 2. It's really the big news is they're going to be, like we've been saying for over a year now, rates are going to be sticky and holding at this level for longer. So rate cuts are now off the table for 2023. So that's pretty much, whereas the markets were pricing in 4 rate cuts between now and end of the year. 0. So the first possible rate cut now is going to be in the first quarter of 2024. So, the markets have to adjust to all that, earnings expectations, GDP, everything has to adjust. So it's going to be interesting the last back half of this year. So strap in. Volatility has been low of late, which is surprising. So just and you've seen this before, but remember, folks, the VIX is the volatility index. It's just what options are trading at. Call and buys, calls and puts, what the markets think is going to occur over the next 30 days. That's the VIX volatility index. So so with that, there's 3 buckets. So right now, we are now in the investable bucket. Wink, wink. So yes, it's investable because it's below 20. So the VIX hit a low yesterday at 13.13, I believe. So 13.13. The average is basically like 19.9, or so let's call it 20 for simplicity. So we're at 13.13. And so that's the investable green bucket. So you typically, i.e. buy when it's low. The next bucket of volatility in the VIX is called the chop bucket. That's in the yellow. So that's when the VIX is between 20 and 30, okay? And that's the chop, which is what we came out of earlier this year, or the first half of this year. And then in regards to the last bucket, it's called the F bucket, and we all know what that is. So that's just anytime the VIX is over 30. So we only had that 1 or 2 times earlier this year. That was it. So that's the nobody makes money in the F bucket. So right now we're in the green bucket at 13. So, and Andy and Eric, we were talking earlier, there's a lot of subcurrents that are going on. So just to touch base on a few of those is the skew index. So the skew index is the abnormalities of just when things are not, when we're all high on the skew, and this is the S&P up here, it just means when you're at highs, the S&P typically pulls back a little bit. So I follow the skew index just as one of many. The smart money, dumb money indicator, okay? So that's like the institutional CFO type money. That's at 18, all-time low. Year to date, it's at a low. Whereas retail money is 81, all-time high as of yesterday, okay? So when you're at a high for retail, low for institutional smart money, it's another checkbox. So what I'm trying to say is things are artificially too calm right now. So, I do anticipate more market volatility. And this was pretty interesting too. Now this is through year-to-date of S&P 500. There's sub-sectors. This comes from First Trust, one of our trusted partners that we use. And that actually, this other thing came from Hedgeye, one of our other partners that we use. But my point is, the S&P 500, as you know, is made up of 11 indexes, but of that, there's 126 sub-indexes, i.e., financials, utilities. Oh, excuse me, there's the indexes there. Houseware, specialties, gold, what have you. But of the, this little chart here, this talks about sub-indexes. It's just interesting how they're negative. And they just showed the top 15, how they're negative. So, and that's year-to-date through 6/12, okay? So I know it's a little few, a week outdated or what have you. But the point is, a lot of subcurrents. So going back to the, what do they mention on CNBC now? The Big Ten stocks or the new, Magnificent Seven or whatever they're calling them, So the Apple, the Google, Microsoft, all that, those companies.
Used to be FANG.
Yeah, it used to be FANG. Yeah. You got it. So now it's just a Magnificent Seven. Okay. So it's just a sales pitch so people tune in. So with those companies are really holding up the indexes, okay? The S&P 500 index in general, QQQ as well. But you subtract out, those, let's just call it, 8, 10 companies. Then the rest of them, the 490 companies that make up the S&P index, or let's call it flat to 1% up for the year. So that's a big divergence. So a lot of cross currents that are going on right now. So that's why we're just sort of talking about that. As far as high frequency trackers and things that we've looked at, ASA is a staffing tracker that we look at. It's just slowly going down. But what we've been focusing on is hourly hours worked. So instead of companies now laying off, which they have at the white collar end, but the blue collar hasn't been hit as hard yet, but they're cutting back hours because the labor is so tight right now. So they're saying, okay, let's cut back white collar first. They've done that throughout the year. Now they're just cutting back hours. So instead of 40 hours, it's 38 to 35, 32. So that's how they're reeling it in that way to try to, without having to lay off people, any more people, I should say. So just a lot of subcurrent things. Again, that's the tracker that we use, all the different charts that we follow as well. So it's just interesting. And then, why don't you hold this one up and talk to it? This is our friend, the Fed.
What's this? The confidence in the chair of the Federal Reserve. So Greenspan looked like people were pretty interested in Greenspan. They liked him. He went down by the end. And then, you follow it through there. We got to Yellen, and then Powell. Powell was looking pretty good there for a little while, right? And then dropped down at the end. Pretty typical, I think, for anyone in Washington, D.C.
Taking the arrows. That's just part of their job, I guess. But it came across that. Thought we'd just share that with you as a little fun fact there. But, it is what it is. There's always, banker and stuff going on. M&A, right? We talked briefly about M&As, mergers and acquisitions. So this is just a chart, M&A. So M&A has been coming down of this quarters over year, but quarters are coming down. So the deals, mergers and acquisitions. So the M&A, we talk about this because we have used some funds that deal in that space. great last year, did perform very well. This year, not doing so well, just because the deals are slowing up. But I just had a call with the wholesaler for that fund this morning, actually. Mark, hey Mark, he always watches. Anyways, the spread. He wanted to make update the spread, meaning the widening spread and the bid-ask price. The spread, it's gotten wider. So things are in the pipeline. They expect a big back half of the year for M&A, mergers and acquisitions, and then the spread being so wide, when they do take a position, they can make more money, so more return.
Yeah.
So we expect a nice bounce back to the year.
Do you know what the factor is that makes the spreads wider?
Good question. I didn't get into it with him. I'm not 100% sure.
Yeah.
I'll go on a limb. I'm pretty confident in this answer is the lack of deals. So when there's a lack of deals, then think of scarcity. You take it away, spread the bid ask. You know, I'm getting at. So I think that has something to do with it.
Yeah, maybe volatility a little bit too.
A little bit of volatility, but again, lack of deals drying up. You know, so I think that could be a factor. But I don't know 100%. But that's my best educated answer to that one. And then going back a little bit to stock ownership. So we're back. Stock ownership among Americans hit a level, the 15-year high. So again, we're back at a 15-year high for stock ownership and retail investors. So it's basically 61% of U.S. adults now have individual stocks either through IRAs, 401ks, or your work benefit plan.
Congrats, America.
Yes.
Heading in the right direction.
Heading in the right direction. But, what's interesting is this, the last time it was that high, I know you're not going to be able to see all this, was back in 2008. So again, going back to the retail side of the shop.
Sure.
So that was the last time, right before, the Great Recession, what have you, and it collapsed. The low was 52% stock ownership. That was through 2013 through 16. Those are the low points, 2013, and then 2016 was a low point as well on stock ownership. And you can see it coming back up. 58 was last year, now 61%, this year, what have you. So it's the high since 2008, and the high water mark was back in 2004. So the highest stock ownership, which is like around 63%-ish, was in 2004. So, that was, and this is through the Gallup poll. This was Gallup asked Americans whether they own stock. They've been doing this poll once a year since 1998. And it's part of its annual economic and personal finance survey. So, that's where we're getting at. So it's just interesting. Yeah. You want people to get back into the markets, but you have to be cautious when all these other indicators are telling you. So we anticipate some type of a pullback over the next few months.
I'm curious. The graph goes down and dips quite a bit. What year is the dip there? 2013 to 16? Okay.
Yep.
Oh, interesting.
And 08 was the Great Recession. So that was the low, excuse me, that was the last time it was that high, 61%. But then the low point is 2013, and then through 16. So that was so just people, running out of money, or they need the money, can't put money in, what have you. So just interesting little facts there. Social Security. So Social Security looks like it's going to be going up a little bit. It's based on basically inflation, third quarter, year over year. So last year. They're going to take a snapshot of this third quarter coming up compared to last third quarter of 2022. The difference is what they come up with as far as the spread for the COLA, cost of living adjustment, that will be pushed out for 2024. The latest, and this is coming from 401k specialists, one of our sources, it's 2.7. So 2.7% is the COLA expected right now for 2024. And the next update comes out July 12th. May's projection was 3.1, got ratcheted down to 2.7 as things come down inflation-wise. So it may go down even less. It could be 2.5 at the next iteration. But, last year's, which took effect in January this year, was 8.7, which was, we haven't seen it that high in 40 years.
Right.
But let's talk about rates. So, with rates being high, it's good and bad. So insurance companies are making more money. Banks can, make some more money as well, per se. The retail investors getting CDs, savings accounts.
Sure.
I haven't talked about CDs forever. Annuities, and fixed annuities forever. Bonds. Yeah. So rates right now, because they're elevated, they've gone high, they're going to be sticky now. All companies, banks, they're all pushing up their rates. You're getting more yield, return. So we've been doing a lot of CDs for clients over the past 9 months or so. And as they come due, just a reminder, folks, for clients, the interest is paid at maturity. So I get that question, people forget. Sure. So, the 6-month CDs is a sweet spot. We've been doing pretty much 95% of people using 6-month CDs, because why go longer out in the yield curve when you're getting more yield for a 6 month than a year, 2, 3, 4, or 5 years? Yeah. So that's why we're doing that per se. Makes sense. Now, yes, you have reinvestment risk, but with the Fed still raising rates. Yeah. So right now, the people who are getting the 4-ish, high 4s, are now getting 5.35% 6-month CDs. That's what's coming out right now. So 5.35 is the latest, and then it's still the high sweet spot for CDs. Yeah. So we've still been doing a lot of that, but also fixed annuities. So I want to hear about more fixed annuities. I know we were on a call here this week. I know Andy and you've been busy, so we've been tapping into you. So thank you.
Yeah, it's been fun.
He's our in-house expert. So
fixed index annuities. This is a good time to think about that sort of thing, because a couple of things that it does. You put money into a fixed index annuity, and it's going to protect the downside, right? There's a kind of a 0% floor there, but at the same time, you have the opportunity for growth, accumulation, and then really what makes them attractive, in my opinion, is income also. Yeah. So, a lot of us aren't going to have pensions, and maybe we're relying on Social Security. To have an annuity that produces an income is kind of like having a personalized pension. Yes. So you can create a paycheck for yourself that hopefully is growing over time, and that can really solidify a plan long term. And it's nice because you can put it both in your name, as well as you can have like joint income. So on you and your spouse, and the income won't outlive you.
Yes. No, I hear you on that. Yeah. And the nice thing too is you have beneficiaries. So, I mean, the one we talked with recently with the client is the long-term care riders. So you can get multiple cash value, death protection, long-term care chassis attached to it with no underwriting.
That's right.
Which is key for people too.
Yeah, for sure.
So what's nice, I mean, just talk about like that aspect of if someone, the ADLs, activities for daily livings. So typically you have to, what's the standard for ADLs, and walk us through like if someone taps into that, it lasts a certain amount of years, but what happens if a person dies?
Sure. Yeah. So this is a particular product that they're the first one to offer this kind of rider. But anytime you would meet 2 of the 6 ADLs, activities of daily living,
bathing, continence,
exactly,
toiletrying, eating, transportation, moving.
You get your doctor's note, you send it along to this company is called North American, and it allows you to flip on a particular rider, the ADL rider. And what that means is that you would, instead of receiving a lifelong income, you would flip it on so that you would receive 7 years worth. So it will take an enhanced amount that is grown quicker than the rest of the portfolio, divide it into 7, and then you would receive that benefit to help pay for long-term care. So you don't take all of your money and put it in something like this, but you could take a little chunk, and it provides a little peace of mind. And what's great about it is that it's different from a long-term care policy in that if you should pass after 2 years, your beneficiary is going to get the next 5 years, whether the beneficiary is your spouse or a child. So you don't lose that money.
Our client was really happy to hear that too, because sometimes under traditional long-term care policy, you're using it, you get it. Let's say it pays out. Here's an X amount, 5 years or 3-year term, and then you die. It's gone.
It's gone. Right. Yeah.
It's like, okay.
Yeah, and like you said, I mean, the health underwriting is a big deal.
It is.
If you're going for long-term care, you have to have pretty superb health in order to get it.
The MIB, Medical Information Bureau.
Yeah.
It's like the government. They know everything about you. What surgery, what drugs, everything you're on. So,
but no medical underwriting for these, which is great.
No, that's awesome.
Yeah. And then you mentioned beneficiaries in general. The fixed index annuities we use, they're not the old school annuities.
Right.
So old school annuities, you take a chunk of money, you hand it over to the insurance company. It's no longer yours, but they're going to guarantee some sort of income for life. With these, you have beneficiaries, and should something happen to you, as long as you still have cash value in the annuity, it's going to pass along. And so it's a much better tool than they used to be.
So we've been dealing and working for estate plans, carving it out when it makes sense for certain people.
Yeah.
So it's just another tool in our bucket that we have here at True North Wealth Partners. So we try to be holistic, one-stop shop.
Yeah.
We got estate planning, in-house tax planners, got the insurance division, Eric heads up. So it's working out great for our clients and everyone. What's
fun about that is that we're able to put options in front of a client that we feel like are good options, but the client gets to decide.
They can decide.
There's no reason, there's no hard sell. So we're happy certainly to provide that kind of information for anyone who would be interested.
We like to educate.
That's right. Yeah, that's a good word. That's a great word.
Yeah. No, that's great. Well, good. Well, thanks for hitting on that.
Yeah.
I guess we'll just end on just a few quick little things here. So, I know we started with the Fed and all that, but I would be remiss if I didn't talk about what happened today. So Bank of England, so they raised rates 50 basis points today. So they raised, they paused, and then raised again. So they didn't anticipate a 50 basis point. Sort of is what it is. Canada's raising, European central banks raising. So all the Turkey raised. I think they're at their interest rates at 15% because inflation's at 40 in Turkey. Have that 40.
Wow.
Yeah, put that in your things. That's crazy.
Yeah.
Another little tip. We talk about tips of the month, but what have you? I guess this is our few little things here. BlackRock. So I am not a big proponent of BlackRock because of what they stand for now. They've altered their ways. Yeah. But anyways, it's funny how when you're one of the largest behemoth in the custodian room. Oh, they're going to get into the spot Bitcoin exchange traded fund.
Oh, interesting.
So they just launched an application with the SEC, Security Exchange Commission, this past week. And so all the fever is Bitcoin's great again.
Sure.
So remember, folks, it's almost 70,000, over a year ago. Yeah. Went down to, in the teens, 18,000. And it cracked 30,000. So it's at the 30,000 mark again. Yeah. So there's a lot of push into that. But when they're doing it for a reason, so this may have a little bit more legs, and I anticipate more action to come as well. Sure. So just wanted to mention of that because that's
good.
Also hot in the news. And then one thing we'll end on is just net worth. I've been doing this, I guess, professionally since. 91. I started as an intern.
Wow. 91.
So it was 91. Yeah, it was old IDS Financial Services down the road here. And then now it got bought out now through Ameriprise. But anyways, those good old days. People, I need $1 million mark. We're good. Okay. So it's increased. Yeah. So let me ask you, what do you think what's the number? Eric, what's my number? What do I need to hit for, in order to be comfortable? So what do you think?
Yeah, sure. I think that's an impossible question. I think it entirely depends on, the client and
their spending.
Their standard of living.
Amen.
Yeah, it's very tailored.
So that was a trick question. So I was messing with you.
Okay.
It's a great answer, Eric.
Yeah.
So anyway, so this just came out, FA Magazine, Financial Advisor Magazine, on June 13th. But Americans say they need $2.2 million in net worth. Okay. So net worth, it's assets minus liabilities, your net worth. So that includes your house, et cetera. So now it's up to $2.2 million. So what I'm getting at is it just keeps on going higher and higher and higher. So, and a lot of folks, our clients, it's all about, for folks who want to take cruises a couple times a year or travel the world, you're going to need a lot more money. But most folks, or don't
Sure.
live their retirement years like that. So
Sure,
you can live on
yeah.
a lot less.
Yeah, and the way I like to think about wealth is if you are living within your means and you're able to give still, you still have money to give, then you're wealthy.
Correct. Yes.
Yeah.
Amen. So it's all about living within your means and your lifestyle and what have
Sure.
you. So that was just a little bit of our episode here. Hopefully you enjoyed it. Thanks, Eric, for popping in. We rotate. We'll get other advisors coming through as well. Add
Thanks
more
for having
insight.
me.
But folks, you take care. Enjoy summertime. And next month will be our 3-year
3 years.
anniversary. All right. You take care.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to any results that may be obtained from this. Investing involves risk, including loss of principal.